Hello, friends. The Social Security Administration does not apply the same rules to everyone, and I do not mean that in a general or vague way at all. Depending on the exact year that you were born, your full retirement age is different, and the mistakes that can permanently reduce your check are different too. The hidden opportunities you have access to right now are different, and the specific threats to your retirement income based on your birth year are different as well. What is happening in 2026 is that people in every single birth year group are either receiving less than they are entitled to or are about to make a decision they cannot undo. Nobody explained what the rules actually are for their specific situation, and that is exactly what I am going to do for you today in plain language. Find your group, listen carefully to what applies to you, and by the end of this video, you will know exactly what to check and what action to take right away. Before we get into it, subscribe to this channel right now and turn on the bell so you never miss a single update like this one. The rules around Social Security change constantly, and when they change, SSA does not send you a personal explanation or a letter that breaks it down clearly for your situation. They change the policy and expect you to already know, and the people subscribed here find out before the deadlines pass and before the mistakes are already made for good. Subscribe now and let's get into it, because your birth year is the foundation of everything else we are about to cover together right now. Social Security calculates your monthly benefit, your full retirement age, your penalty for claiming early, and your bonus for waiting, all based on the year you were born. Two people who worked the same years, earned the same income, and retired at the same age can receive different monthly checks for the rest of their lives simply because of their birth year. That is not a rumor or a misunderstanding. It is exactly how the system is built. And once you know your group, the specific rules that apply to you become very clear. Group 1. If you were born between 1943 and 1954, you are between 72 and 83 years old, and your full retirement age was 66, and you have likely been on Social Security for a while now. Most people in this group assume there is nothing left to check or optimize, and that assumption is costing some of you real money every single month right now. The first thing people in this group need to look at is whether they are collecting the right benefit, because a significant number of widows and widowers are on the wrong record. Many people in this age range are collecting their own retirement benefit when they would actually receive substantially more by switching to their late spouse's survivor record instead. The survivor benefit for a widow or widower can be up to 100% of what the deceased spouse was receiving, and that difference can add up to thousands of dollars every single year. If you lost a spouse and have not specifically asked SSA to compare both benefit amounts and confirm you are on the higher one, there is a real chance you have been leaving money on the table. This is not a complicated process. You call SSA at 1-800-772-1213, ask them to pull both figures, and request that your benefit be switched to the higher record if it applies to you. One phone call, permanent change, and that higher monthly amount continues for the rest of your life once the correction is made and processed by SSA. The second thing for this group involves the Social Security Fairness Act, which took effect in January 2025 and eliminated two provisions called WEP and GPO that had reduced benefits for decades. If you spent any part of your career as a teacher, police officer, firefighter, federal employee, or other public sector worker, this law may have already increased your monthly check. It also generated a retroactive lump sum payment covering back to January 2024, and the average back payment has been approximately $6,710 for eligible recipients across the country. SSA has been processing these adjustments throughout 2025 and into 2026, but not every eligible person has seen the correction applied to their account just yet. Log into your My Social Security account at ssa.gov and look at your current benefit amount to see if it increased since early 2025, as it should have for public sector workers. If it has not increased and you had a government pension, call SSA and ask specifically about your WEP and GPO adjustment, because the correction may simply be waiting to be processed. The third thing for this group is Medicare. and specifically whether you are being charged extra on your Part B premium right now based on income from a year or two ago. These surcharges, called IRMA, are triggered by your income from 2 years prior, and in 2026, the standard Part B premium is $202.90 per month per person. If your income was elevated in 2024 through a property sale, a large IRA withdrawal, or any one-time payment, IRMA surcharges in 2026 can add anywhere from $81.20 to $487 per month on top of that standard premium. If your income has since dropped because that was a one-time event, you can appeal using Form ssa.44, which you can download free at ssa.gov, and potentially have those surcharges removed entirely. People in this group who successfully appeal their IRMA are saving between $1,000 and $5,000 per year, and that money comes back to you every single month going forward. Group 2. If you were born between 1955 and 1959, you are between 67 and 71 years old, and this is the most critical group in all of 2026 because your rules differ by every single birth year. Here is the full retirement age breakdown for this group exactly, and your specific month matters more than most people realize when it comes to calculating what you are actually owed. If you were born in 1955, your full retirement age is 66 and 2 months. Born in 1956, it is 66 and 4 months. And born in 1957, it is 66 and 6 months. If you were born in 1958, your full retirement age is 66 and 8 months. And if you were born in 1959, your full retirement age is 66 and 10 months. That is your number, not a round figure. If you claim Social Security before that exact month, your benefit was reduced permanently by a fraction of a percent for every single month you were early, and that reduction never goes away. On a benefit of $2,000 per month, claiming even 6 months early can cost you $60 per month for the rest of your life. And over 20 years of retirement, that is $14,400 gone from a 6-month gap. This group is also dealing with the earnings test in 2026 if you claimed before your full retirement age and are still working at any level right now. The earnings limit this year is $24,480. And for every $2 earned above that amount, SSA withholds $1 from your monthly benefit check, which feels like a penalty, but is actually not one. Most people who experience this think their money is simply gone forever. But here is what almost nobody explains clearly. It is a deferral, not a permanent loss, and the money comes back. After you reach your full retirement age, SSA recalculates your benefit to credit you for every month benefits were withheld, and your ongoing monthly payment goes up permanently from that point forward. For people in this group who have not yet claimed, the math of waiting past your full retirement age is something you need to understand before you make any decision at all. Every month you delay past your full retirement age adds 0.2% to your benefit permanently, and over 3 full years, from FRA to age 70, that is a 24% permanent increase. On a $2,000 monthly benefit, that 24% increase is $480 more every single month for the rest of your life. And every future COLA increase is worth more in dollar terms on top of that higher base. Group 3. If you were born between 1960 and 1965, you are between 61 and 66 years old. And for this entire group, full retirement age is now exactly 67, locked in permanently. This is the final step of a change that began back in 1983, and 2026 is the year it locks in completely with no further scheduled increases beyond 67 under current law. What this finalization means for your group specifically is that the penalty for claiming early is now at its absolute historical maximum, and the numbers are ones you need to hear clearly. Claiming at 62 with a full retirement age of 67 reduces your monthly benefit by 30% permanently, and on a $2,000 monthly benefit, that is $600 less every single month for the rest of your life. Over 20 years of retirement, compared to waiting until 67, that early claim costs you $144,000 less in total lifetime income. And compared to waiting until 70, the difference exceeds $259,000. SSA will process your early claim without warning you about this in clear dollar terms. They will ask if you understand your benefit will be reduced. You say yes, and that reduced number becomes your permanent baseline. There is also something this group almost never hears about, and it involves a lump sum option that SSA will not mention unless you ask them directly about it. If you are already past your full retirement age of 67 and have not yet filed for Social Security, you may be able to request up to 6 months of retroactive payments as a lump sum when you do file. On the current average retired worker benefit of $2,071 per month, 6 months of retroactive payments comes to over $12,000 delivered with your very first payment from SSA. There is a trade-off. Your start date shifts back slightly, which reduces your ongoing monthly amount. But the option exists, and SSA will not mention it unless you ask directly when you file. For people in this group who are currently between 61 and 63, specifically those born in 1963, 1964, or 1965, there is a retirement savings window open right now that closes the moment you turn 64. The Secure 2.0 Act created what is called a super catch-up contribution for workers aged exactly 60 through 63, and in 2026, if you are in that age range, you can contribute up to $35,750 to your 401k. That compares to $32,500 for other workers over 50. And 3 years of contributions at this level can add over $100,000 in tax advantage savings before the window closes permanently at age 64. If you are 61, 62, or 63 right now, confirm with your HR department that the Super Catch-Up is available in your specific plan and use it to the maximum amount this year without waiting. For people in this group who are still 5 or 6 years from claiming, the single most valuable action you can take right now is checking your earnings record carefully at ssa.gov. Open your Social Security statement and compare the earnings listed for every single year against your own W-2 forms or tax returns, because errors in this record are more common than most people know. Each year, where the record shows a lower number than what you actually earned, or a 0 during a year you were clearly employed, reduces your eventual benefit by approximately $100 per month permanently. Finding and correcting these errors now, while you still have documentation and time before claiming, is the single highest return action available to anyone in this group at this stage of their planning. Group 4. If you were born in 1966 or later, you are 60 or younger, your full retirement age is 67, and claiming at 62 means a 30% permanent reduction. Those numbers are fixed for your generation. But what is not fixed yet, and what your generation specifically needs to pay attention to, falls into 3 areas, and the third one is the most significant long-term financial risk on the horizon. First, if you just turned 60 in 2026, born in 1966 specifically, you are entering the super catch-up window we just discussed. And in 2026, you qualify for the $35,750 total 401k contribution limit. You have 4 years, ages 60 through 63, to take maximum advantage of this window before it closes. And preparing your finances now to maximize those contributions every year matters enormously. If you are younger than 60 right now, this window is coming for you. Mark it on your calendar today and begin positioning your finances so you can maximize contributions the moment you enter it. Second, your earnings record. SSA has been recording your payroll data since your very first job, and that data came from employers. And in every single year of that process, something could have gone wrong. A wrong number submitted by an employer, a year that was missed, a period of self-employment not reported correctly. For your generation, these errors represent a real probability of at least one inaccurate year. Each such year costs approximately $100 per month in future benefit permanently, and documentation is far easier to locate right now than it will be 10 or 15 years from today. Log into ssa.gov, open your Social Security statement, and check every single year against whatever records you have, W-2s, tax returns, pay stubs, and file a correction if anything is wrong. Third, and this is the one your generation has the most at stake on. In February 2026, the Congressional Budget Office moved its projected depletion date for the Social Security Trust Fund forward to 2032. That is 6 years from now. And if Congress does not act before that date, Social Security can only pay approximately 77 cents for every dollar of scheduled benefits from incoming payroll taxes alone. That is an automatic across-the-board reduction of 23% for every recipient. And for your generation, which in many cases has not yet claimed and is counting on Social Security, this is a risk worth watching closely. This does not mean Social Security is going away. It means your generation has the most to gain from staying informed and the most to lose from assuming the situation will simply resolve itself without paying attention. So here is the full picture by group, and I want you to walk away with every one of these action items clearly in your mind so you know exactly what to do this week. If you were born between 1943 and 1954, verify your survivor benefit situation right now. Call 1-800-772-1213, check whether your WEP and GPO correction has been applied, and look at your IRMA charges. If you were born between 1955 and 1959, know your exact full retirement age down to the month. Understand that earnings test withholding comes back after FRA, and calculate delayed credits before any claiming decision. If you were born between 1960 and 1965, understand what a 30% permanent reduction means in real dollar terms. Ask about the retroactive lump sum option if you are past 67, and check your earnings record now. If you were born in 1966 or later, use the super catch-up window if you are 60 to 63, verify your earnings record while documentation is still accessible, and stay informed about the trust fund timeline. None of this will be sent to you in a letter. SSA processes applications and changes the rules, and they expect you to already know which group you are in and what it means for your specific situation. Subscribe to this channel and turn on the bell so you are always in front of these changes before they affect your check. And share this video with someone you know who is in one of these 4 groups. One conversation with the right information at the right time can protect someone's retirement income for the rest of their life. And I will see you in the very next video.